Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 313 of the Independent Advisors Podcast. On today's show, we are covering a few timely and important topics, including the semiconductor industry, the healthcare sector, the growth in the tech sector relative to the S&P 500, stock buybacks, survey data, and be sure to listen to the end where Taylor talks about Roth conversions during the financial planning topic of the week. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you, so let's jump in. S&P 500 index up 2% so far for the month of August and up 9.9% on the year. The Dow Jones Industrial Average up 1.8% for the month and up 5.6% on the year. The NASDAQ Composite Index up 2.8% for the month and up 12.4% for the year. The Russell 2000 Small Cap Index up 5.4% for the month and up 4.6% for the year. And the Vanguard All World X United States Index Fund is up 4.4% for the month and up 21.1% for the year. 3-month Treasury rate at 4.29%, the 2-year Treasury rate sitting at 3.67%, and the 10-year Treasury rate at 4.24%. So historically, Matt, August has not been the greatest month for stocks. And I know, a lot of that weakness, if we look back in history, is in the second half. But so far, from a seasonality standpoint, stocks seem to be bucking the trend a little bit.
They definitely do. I'm going to have some data coming up about kind of the sentiment survey, and I'm going to meld that into how I think market action could end up over the next couple of months. My personal opinion, and I'll be curious to see how you react to it.
Okay. Well, moving on to big headlines and current events for the week. This week, the Trump administration extended the tariff pause on China until November 9th of this year. So
the taco trade's alive and well.
Yeah, it is. So some more time there to get a more firm deal done with China. I'll have something on this next week, but just as a little bit of a preview, someone had a post on X where they posted the chart of ticker symbol XRT, which is the retail ETF.
Keep going. And
it's at yearly highs or year and a half highs, 2-year highs, something like that. And they said they all told us that the shelves would be empty due to the tariffs
this summer.
Yeah. So I'll talk about that next week. Not a political statement, just more of the, again, people guessing or forecasting what's going to happen, and the opposite happens.
Yep.
So
well said.
CPI report for July came out this week. So CPI rose 0.2% in July on a monthly basis, and the annual inflation rate remained at 2.7%, which matched the June rate and came in slightly below expectations of a 2.8% rise, which is a good thing.
But that's huge news. For our newer listeners, the CPI stands for the Consumer Price Index. It is a index that the government provides once a month to provide their viewpoint on inflation. And when they come out with the numbers, they annualize it, which is what you just mentioned.
Yeah. Yep. Last but not least, the volatility index dropped by 9.24% to 14.74 on Tuesday, August 8th, and this is its lowest close of the year so far. So it's just interesting how we went from, this massive, I guess you could call it, volatility tsunami in April.
That's an understatement.
And then here we are today, and the VIX is at the lowest rate. The volatility index is at the lowest rate so far for 2025.
That wasn't on a lot of people's bingo cards. And again, this is going to blend into my sentiment survey topic. And so I'm pretty fired up about it. So I'm going to save my talking points.
Great. Moving on to tweets, articles, and research from this week. The first thing that I had was a post on X from Seth Golden about semiconductors. So he says, the semiconductor bang theory. First time semis have expressed a 4-month win streak in more than 6 months. History informs us that every single time this has happened in the past, which has been 18 separate occurrences, semiconductors were higher 6 months going forward for an average return of 13.5%. So the reason why I bring this up is semiconductors is one of those industry groups that tend to lead the market in both directions.
Correct, sir.
So if we are in a bear market or a correction and we see the semiconductor industry start to turn around, we can say, hey, more likely than not, using history as our guide, the market might be close to a bottom, and vice versa. If semiconductors start to underperform in a bull market or a strong market, that should, perk our ears up a little bit and say, hey, this isn't normal in a strong market. Semiconductors should be leading. Is this time to take risk off the table, or is the market at a turning point? So on and so forth. So, I think this is good news for investors in the market, and specifically investors in semiconductors. We've kind of talked ad nauseum on this show about how important that industry is to the global economy and all of our everyday lives. So this is another good piece of information for semiconductor bulls.
And my quick reminder for pretty consistent listeners is on last week's podcast, episode 312, Nick Whitaker talked about projected energy usage of data centers over the next 3 years. And you think about just what the spending could be projected to be on these data centers in the next 3 years. Again, it's a projection, but that's a pretty important portfolio theme, and these are some pretty important companies to a lot of these indices like the NASDAQ 100, the S&P 500, et cetera.
Yeah, and the other thing that happened over the weekend, or it was earlier this week, I think it was on Sunday, AMD, Advanced Micro Devices, and NVIDIA announced that they will be they're setting up like a profit sharing or revenue share to the U.S. government on their chip sales to China. So specifically, they are going to give the U.S. government 15% of sales.
Gross
sales that they make to China, so that they can continue to sell chips to China because it's a big market for them.
Yeah.
What's your 2 cents on that?
I got a hot take. I love it. I'm going to tell you why. Because my understanding is a lot of these chips have been sold through Singapore and Vietnam and make their way to China anyways. So why don't we get a cut of it? I know it's a hot take. Mm-hmm. Love it.
Yeah. So interesting.
It clears an overhang with the stocks. And anytime these overhangs get cleared, not a recommendation for or against NVIDIA, AMD, and the next name I'm going to mention, Apple. Look at what happened to Apple when the overhang was cleared with the administration and tariffs. Stock rocketed.
Right.
So again, not recommendations for or against these names on the podcast. We're doing in relation to the news that we're talking about. I think it's a good thing for the overall market.
Yeah, good points. Next was a post on X from Rob Anderson using NDR research or Ned Davis research. This was back on August 1st. And Rob says healthcare pessimism could be nearing an extreme. The sector's weight in the S&P 500 has been roughly cut in half since the end of 2022 and now makes up just 8.8% of the index, its lowest weight since 1994. So I just thought this was interesting. Again, not a recommendation for or against the healthcare sector or any of the individual stocks that make up that sector. But I did find this pretty intriguing just with everything going on. I think, especially in the political sphere, you have UNH, which is one of the larger companies in the world, or was one of the larger companies in the world.
Correct.
And you had, the whole situation happen with one of their executives getting killed. They were more in the spotlight about potentially harmful practices as an insurance company. But putting all that aside, if you look at the company, that company prints cash.
They do.
Right?
From you look at the balance sheet and the cash flow statement.
And I think, I can do some more research on this to give firm numbers, but I think off of its highs, UNH is down around 50%.
That sounds about right to me. That's what I was going to say.
Which seems kind of crazy for a name that's as financially sound.
It was a top 20 market cap name in the S&P 500.
And consistent, right. So, and this has happened with a lot of these names. Eli Lilly is another name that has gotten hammered pretty good. So it's just the healthcare sector, there are several names, like I just mentioned, UNH, Eli Lilly, Johnson & Johnson, that, could potentially be pretty attractive because they've been mainstays in the U.S. economy for so long. And when you think of blue chip U.S. stocks, those are the type of names that you think of, right?
Sure.
So not saying, this underperformance from healthcare could last a lot longer, could last a couple of years longer. But what I will say is that, especially with the last two administrations that we've had, so the Biden administration and the Trump administration, correct. Trump's first term, right? Okay. So we've talked about this before, but just to reiterate it, when Trump got into office, everyone was negative on clean energy stocks and bullish on traditional energy stocks, your coal, right?
Yep.
And during Trump's first term, clean energy did really well, coal not so good. Then you go to the Biden administration, they think clean energy stocks are going to do really well, and then it flipped. Old traditional energy did well and clean energy did poorly.
Yes.
So I'm just throwing that out there because, RFK's in office and people think he's going to shake up the healthcare industry, and people might be negative on that.
Yes.
It might turn out to be the opposite in the long run this term.
You nailed one of the things I was going to say. Here's the second viewpoint, and this is more of a hotter take. I feel Wall Street in general has been wrong, and I would argue very wrong, since March, April, up until now. And let's just say that viewpoint and sentiment is reflected inside their and clients' portfolios. Now you got to play catch up. And so if you got to get back into the market, are you going to buy a stock that is growing earnings at mid-single digits, or are you going to be buying stocks that are growing earnings at double digits to try to make up some lost ground? And I think what's happening is the healthcare sector, it's just not a sexy sector. It's not growing earnings quick enough. And I think that is another reason, I know it might be a hot take, another reason why it's being left to the side. And like you said, just because it's a deep value now doesn't mean it's going to turn around instantaneously.
Yeah, could get cheaper.
But two excellent points, Mark.
Yeah. Last thing, talking about the tech sector a little bit, it was a blog post from Bespoke Investment Group on July 28th titled Tech Sector Now 1/3 of the S&P. So they say the only time the sector's weighting has been higher was during a brief window in the early 2000s at the peak of the dot-com bubble. Back in 2018, those in charge of sector classifications reorganized many stocks in the S&P. Already big stocks like Alphabet and Facebook were shifted out of the technology sector and into the newly classified communication services sector. This resulted in a big drop in the tech sector's weighting in September of 2018. Tech would have had a weighting in the S&P 500 of roughly 43% right now, rather than 33.6% if pre-2018 classifications were in place. In my opinion, Matt, I don't know how you feel about it, but Google and Facebook or Meta are tech names.
Yeah, they are.
So, I
Absolutely.
classify them as that.
Absolutely.
But, the reason I bring this up is that this consistently every couple of months continues to creep into the major news headlines, or at least the stuff in the research that I'm reading.
Yeah.
And how this continues to be a problem. It continues to be a problem that tech makes up such a large portion of the S&P 500. And my two comments are, number one, this isn't the first time this has happened. This has happened over time, going back 50, 60, 70 years.
Correct.
And number two, if this was an issue 5 years ago, 3 years ago, 2 years ago, are we just going to say this in perpetuity, or are people trying to call a tech explosion? I'm just trying to
broken clock's right twice a day.
Understand what people are trying to get at, because this isn't the first time we've had this conversation over the past 10 years.
Well said. I mean, anytime someone tries to provide an analogy to the dot-com bubble to now in regards to the tech sector weightings, two very, very valid, important points that they don't want to acknowledge. First is the balance sheets of the tech companies today versus the tech companies of the year 2000, night and day. Don't get me started. Second point is the reoccurring revenue model. You look back, the revenue model for all these tech companies in the late 90s was transactional. Now the revenue models of these tech companies is reoccurring. Mm-hmm. Oh my gosh.
Yeah. Two very different periods. So just wanted to throw that out there, because that is something that is popping back up in financial conversations now.
Sounds like people are grabbing at straws.
Yeah, I agree. But that's all I got, so I will hand the reins over to you.
All right, I'm going to be a little quicker than normal this week. You know, volatility's on the lower end, so the first thing I'm going to highlight is...
Famous last words.
It is. This is like usually the contrarian indicator. You know it's going to pop up. We should buy the VIX. Lots of stock buybacks announced in July. So I saw this from Bernini Associates. The date on this, Mark, August 6th. And Jenna will put up this chart for our YouTube viewers. This will be in our show notes. What it illustrates is that in the single month of July, dating back roughly 20 years, American companies here have announced $166 billion of stock buyback announcements. And this is one of the highest levels, clearly, that has been announced in a single month going back 20 years just for the month of July. Will you take just 30 seconds? What is a stock buyback?
Yeah, so essentially what a stock buyback is it's a way for companies to kind of return cash to shareholders or make the shares more valuable, right?
Sure.
So, there's shares on the open market. If you remove some of those shares from the market, theoretically, the value of the existing shares should go up, right? So, for example, earnings per share will be higher if nothing changes with the company financially, because there are less shares in the market. So it is a way to reward current shareholders, would be the best way to explain it.
And if you think about that, if you're going to have that company actively in the market buying back their own shares, now the company is competing with other shareholders, and let's say Wall Street's underweight equities. That's my take, and people might view it differently. You're going to have some competition now from the companies themselves retiring these shares. You have another area of demand. And, stocks prices are a supply and demand metric. Mm-hmm. Just another indicator of demand.
And the last thing that I'll throw out about this is, are they going to get this right? Not every single time, but these companies, they're not dumb, right? And if they're buying back their own shares, I think my personal opinion is they think the shares are cheap.
Correct.
I don't think they would be buying back shares if they thought their companies were overvalued or extremely overvalued.
Well said.
So I will throw that out there.
Well said. So my next piece is about sentiment surveys. So the weekly AAII Investor Sentiment Survey was just released this morning. This is fresh, hot off the press, August 14th. So the American Association of Individual Investors, their sentiment survey, it measures a percentage of individual investors who are either bullish, bearish, or neutral. You can only answer one of three ways on the stock market's direction over the next 6 months. It's often viewed as a contrarian indicator. Extreme optimism or pessimism, Mark, as you know, can signal potential turning points in the market. While not a market timing tool on its own, it's definitely a useful gauge of overall investor mood and, let's say, risk appetite. So why am I highlighting this? Despite volatility coming down, the market doing substantially better from March and April, some indices are hitting new all-time highs, some are close. you now have bullish indicators are trending down and bearishness levels are rising. Now, to take it even further, the level of bullishness is now back to a level it was at the beginning of May, end of April. From my vantage point, gosh, do I love to see this, okay? Because the market's doing better, volatility's coming down, and boy, is this rally hated. And I love that. I'm going to continue before you respond. Bearish calls from Wall Street continue. This is from Neil Sethi on August 4th. I'm just going to throw a couple of these out there just to give our listeners and viewers some flavor as to Wall Street's attitude right now. Morgan Stanley strategist Mike Wilson sees a correction of up to 10% this quarter as tariffs hit consumers and corporate balance sheets. Evercore's Julian Emanuel is expecting a more substantial decline, as much as 15%.
I like, where are they getting their correction of 10% this quarter, or a decline of as much as 15% this quarter? That it's literally, to me, it's just picking numbers out of the sky.
Yeah, I think they're talking their book because they were calling for a major recession back in March and April. And obviously, again, it goes back to my thought process that some of these firms are well underweight equities. And I'll give you an example. What the note said, and I'm quoting now, the calls are coming in amid mounting concerns about U.S. economy after data last week showed an uptick in inflation, as well as the weakening job growth and consumer spending. In addition, stocks are entering what's usually their weakest time of the year, end quote. So here's where I stand on this. My 2 cents. I love to see this. I love to see the market climb a wall of worry. Again, Wall Street, for the most part, has been wrong since March, April time period. If their view in the market reflects how them and their clients are allocated, they're underweight stocks, which means to me, the dips are going to be bought. Mark, thoughts, comments?
Yeah, it's just more of the same that we've seen. So to give people an idea, so back on April 9th, which was just at
2 days after the market bottom in retrospect.
Right. The bullishness level of people surveyed was like 28.5%. Mm-hmm. And now on August 13th, we're only at 29.9%, which is crazy because the market's up substantially since that low, right?
Yep. People don't like buying things when the price goes up in the stock market.
Yeah.
Right?
Yeah.
Right?
Yeah.
They think they have the consumer mentality of, I want to buy it when it's on sale.
Right. But then we all know once it gets on sale, it's like, I don't
want to do that.
Right. I mean, UNH, 50% haircut where really nothing has changed in their business for the most part.
Sure.
Right. In terms of free cash flow, earnings growth, revenue growth, they still print money. But yet it's on sale. And, I've seen articles and things about institutional investors and hedge funds, buying up UNH shares because they think it's such a steal. And I guess we're going to see if they're right or not here over the next year or two.
The market could be right over the next couple of years, and the shares are appropriately priced. And again, it's an interesting illustration. Again, not a recommendation for or against the name, but I love you using that as an example because it's very real time right now.
Yeah. And then the last thing is, again, I know I say it all the time, but I'm just so sick of these strategists for these, Wall Street banks coming out and saying, I can see a correction of up to 10% this quarter. It literally doesn't do anything else other than harm people because it'll cause people to sell. I can assure Jenna
I did not do that on purpose.
It really is. It's just like, if you ever come across somebody in our industry or anyone in general that they tell you they know what the market's going to do, you should turn and sprint in the other direction because no one knows what the market's going to do, including Mike Wilson from Morgan Stanley. I don't care how respected he is. You don't know. You don't know if there's going to be a correction of 10% or not. So that really bothers me if you couldn't tell.
No, I get it. And if people are curious, let's just take his name as an example. If you Google search some of the calls over the past 3 years, they're not exactly
not great.
Wonderful.
Yeah. Yeah. Anyways, maybe that's a job that AI will take over, is like Wall Street strategist and forecasts.
We can start bashing ChatGPT's forecast.
Right. So
see, this is why when it comes to investing, I just really prefer to be, instead of talking about the overall market, and this is what gets into the minutia and the granular level of what we do day to day, we're focused more on individual names and what they're doing. And that makes me a lot more comfortable as an investor. I'm not just relying upon the overall market to do well.
Right.
I'd rather put my stakes in the ground with individual names, and that's a conversation for a different day.
Yeah, very well said. Well, I'm going to bop out of here and let
Yes.
Taylor come in for the financial planning topic of the week, but I'll see y'all next week.
You did awesome, Mark. Hot takes this week, hot takes. So incoming is podcast fan favorite Taylor Ledbetter. Taylor handles all the financial planning here at Jessup Wealth Management. Taylor, welcome to the podcast.
Yeah, it's good to be back.
What's new in Taylor's world?
Oh, not much. I mean, I had a lot of traveling this summer, and that's kind of over with. So the rest of the year is just going to be relaxing.
Kind of back to normal?
Yeah.
It is nice when you come back from trips just to get back in the normal routine.
It is, yeah.
And I think what happens is when we are in that normal routine for an extended period of time, we, as human nature, we take a lot of things for granted. And when we travel, all of a sudden we start getting back into that routine and we're like, I appreciate this a little bit more. That makes sense?
Oh, yeah. I definitely miss my routine if I'm gone, especially for a long time.
See? See? So what'd you come up with for listeners and viewers this week, Taylor?
Yeah, so today I wanted to go through some questions that I found on Kiplinger.com.
Okay.
These questions are specific to Roth conversions.
Okay.
There's some stuff in here about like RMDs and maybe inherited IRAs, but you can submit questions like to Kiplinger.com
Okay.
and an editor responds back like via a blog post. So
Sure.
I just thought that these would be really interesting to go over.
All right, let's dig into it.
So these are going to be real life questions from people who submitted them on this website. But the first one is, my husband owns one traditional IRA. He turns 73 this year and wants to wait until the first quarter of 2026 to take his first RMD. Can he do a Roth conversion in 2025 before taking his first RMD in early 2026?
Like this. I like this a lot. Keep going.
So something that is a little unique, if it's the first year you're taking an RMD, those first year RMDs you don't have to take until April 1st of the following year. After you get past that first year, the deadline is December 31st. So that changes.
Correct.
But RMDs do have to be taken first before conversions. So in this case, even if you would take your first RMD in 2026, you still couldn't do a conversion until after that.
Got it. Has to be satisfied first.
Correct.
What's your thoughts? I think also people forget, let's say in this example, the individual's like, yeah, I'm not going to do the RMD till next tax year. I think some people might end up forgetting, yeah, you're taking that taxable withdrawal next year and you're satisfying next year's at the same time, right? You're like, you have a double dose from a tax perspective, right or wrong.
No, yeah, that is correct.
And so that within itself could have its own factors. I mean, if you have a sizable IRA, and let's just hypothetically say that required minimum distribution, I'm going to throw out a hypothetical, $25,000. Well, if you don't do it in that first year and you're like, I'll satisfy it by April the following year, all things equal, then you're taking $50,000 of income that's going to be recognized through a 1099-R. And that could really mess up their taxes, right? If they don't spread it out over a couple years.
Yeah. And that's typically why we probably wouldn't recommend saving it for the following year.
Yeah.
I mean, of course, there's those special circumstances, but yeah, that was a good thing to point out.
Yeah, I see that sometimes people think that way, but then they forget, oh yeah, I do have to satisfy next year's in addition, right? Yep. You can't keep kicking that can and trying to do the prior years by April of the next year. It's only a one time, right?
Correct.
Yeah.
Yep. So the next question is, I have 4 traditional IRAs and I want to convert part of one of my IRAs to a Roth this year. I know I have to take my annual RMD for 2025 before I do a Roth conversion. How does this rule work for people with multiple IRAs?
Oh, this will be good education for our listeners and viewers. All right, continue.
Yeah, so kind of similar to question 1, the RMDs do have to be taken before the conversion. Obviously, if you have 4 IRAs, you have 4 different RMDs. So whatever that total amount is just has to be withdrawn before you do any conversion.
And it doesn't have to be taken from the accounts individually, in this example, 4 of them.
Correct.
You can, and correct me if I'm wrong with any of this, you can satisfy the RMD for all 4 accounts from a single one. The government just wants to see that you took that money out and it becomes taxable income.
Yep, that's
Right?
completely right. Yep.
Okay.
So yeah, that one was pretty straightforward, kind of similar to question 1.
Okay.
So the next question is, I'm thinking about a Roth conversion this year.
Okay.
I know that I will owe income tax on the converted funds. Are there any other adverse tax impacts that I should know about?
Okay.
So, I mean, other than the, ordinary income tax you'll owe, there shouldn't be any tax surprises. But one thing that I think people should think about is how they're going to pay taxes on that conversion, because you have a couple options. So when you're doing a Roth conversion, you can withhold federal and state taxes from the conversion itself.
Correct.
So if you're moving, $100,000 over, and maybe you're withholding 20% between federal and state, you really only move over $80,000.
Correct.
So that's one option. Another option is to just pay those taxes from an outside account, whether that's bank account or an individual account with, stocks and bonds. So ideally, we would love if you could pay taxes from an outside account. That way we could convert more. But a lot of times people might not have that large of a lump sum maybe.
To free up outside of the retirement account to pay for that.
Correct.
Right? 2 other thoughts that come to mind initially. One, it's in regards to overall taxes. So let's say there's a year where someone does a Roth conversion, and let's say they realize a ton of gains inside their after-tax account. That could end up affecting their Medicare premiums, right? Because of the amount of income that they're taking. And I know that's something that you highlight a lot when you were doing planning work for clients. So that's another area I heard you bring up in the past. And then another general item I want to throw out there for our listeners and viewers is not only your knowledge, but I know you have certain softwares that you use for the firm where you can do a lot of the forecasting in these Roth conversions and show them the tax savings over a period of time and the amount of money that it might be beneficial in passing on to that next generation. And I want to throw this out there that whether you're a client or not, if this is something you have an interest in having Taylor look at, definitely reach out to her and we'll make sure we'll talk about your blog post here at the end.
Yep, absolutely. So the next question was, can a non-spouse beneficiary of an inherited IRA convert it to a Roth IRA?
Oh, we get that question often, don't we? You have to get it all the time.
Yes, I have.
Yeah.
And so the answer is that inherited IRAs cannot be converted to IRAs. Inherited IRAs have their own just funky set of rules.
Well said.
For anybody who isn't familiar with how they work, inherited IRAs, if it goes to a non-spouse, do have to be depleted within 10 years of the original owner's date of death.
See, this is just a great time for me to say it. So if you're a listener and viewer and you're thinking about some of these topics, you can go to jessupwealthmanagement.com. Right at the top bar, it'll say Tailored Finance, and in quotes, it'll say blog. When you go to that site, you are going to see all of Taylor's historical blog posts and Jenna inputted at the top, you can search those blog posts. So let's say you want to learn more about inherited IRAs. You can go in now very quickly, type in inherited, and it's going to screen a lot of Taylor's posts and content so you can kind of dig through and see some of that key information that Taylor has curated over time. And so I just want to throw that out there, that I think that's going to be popular as time goes on for you.
Yeah, I definitely have blog posts with all these topics on there.
Yep. And it's popping into my head. I remember Taylor doing that before. I remember that. I just want to make sure. I'm going to try to do my best going forward to make sure people realize it's super easy to go in there and search that stuff now.
Yeah, that's great.
Yep.
So the last question, I think this one is really good.
Okay.
So it says, I understand that to withdraw money from a Roth IRA without paying taxes or a penalty on the earnings, the account owner must have had the money in the Roth for at least 5 years and be age 59 and a half or older. My question relates to when the 5-year clock starts when contributions are made over several years. Do the rules differ for Roth IRA conversions?
Good question.
So I think the 59 and a half rule, I think that's pretty well known that you have to be that age to withdraw funds or there's a penalty. But there is another rule, which is your contributions to a Roth have to be in there for 5 years for the earnings to not be like taxable or penalized.
Important. Yep. Yep.
So this person is basically asking, if I do a conversion, does that 5-year clock start over? And my answer is yes. So any like contributions or conversions or rollovers do start that 5-year clock.
That's a good one. I didn't, you don't think about some of that stuff as often, right?
Right.
That's a great question.
Yeah. So basically, if you're doing a Roth conversion, just know, you'll have to wait about 5 years before you can really start living off of that money. A lot of times the conversions mainly benefit the next generation too.
I've heard you say that a lot. Yep.
Yep. That's a huge benefit. Of course, it saves you taxes as well, but a
Sure.
huge benefit for the next generation. But I thought all those questions were a little more detailed than maybe we've gotten into in the past, but very real life scenarios.
You have tons of knowledge on these topics. For newer listeners, Taylor is a CFP, a certified financial planner. So definitely go to the jessupwealthmanagement.com website. Check out Taylor's blog post. Again, they're searchable. Wealth of knowledge. Thank you, Taylor. Appreciate that. Anything before we sign off from your vantage point?
No, I don't think so.
Only thing I can think about that's top of mind is late August, early September, we have a Fed conference in Jackson Hole that will definitely get some headlines as you get some speeches from various regional Fed presidents, including Fed Chair Jerome Powell. That could definitely make a lot of headlines, I think, in a couple of weeks. You're going to have earnings announcement coming up from the largest market cap stock in the world, not a recommendation for or against, NVIDIA, at the end of the month. I know a lot of people look at those types of earnings pretty closely. So I think on the horizon, those are next couple of the topics that I think the market might be focused on that I want to throw out there. So thank you for listening to episode 313 of the Independent Advisors Podcast. Myself, Taylor, Jenna, Mark, Aaron, Nick, rest of the Jessup Wealth Management team appreciate you listening, and we'll be back next week with episode 314.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of The Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.